Good morning. It's Friday, August 19th, 2022. It's 4:46 a.m. on the East Coast. It's 10:46 a.m. Central European time, where I currently am located. Um, my big takeaway from this week's market action is that this market is dealing with a very tall wall of worry. It's hard to recall the last 20 years of market memory for me and all the different events. Obviously, there's been plenty of times where there was a really tall wall of worry. There was a lot of fear and things that could go wrong in the world. But this time really stands out, quite frankly. And it's really hard to figure out which way things are going to break. It's really hard. Most people were caught wrong-footed by the recent market rally off the June bottom. Most people were not benefiting much from this 2-month rise we've had off of a deeply oversold low in mid-June. But here we are today. We can't worry about the past and can't dwell on it, but here we are today. And suddenly, looking at various headlines, like I posted on CEO, confidence among individual investors hit a new high for the year. And then in the same breath, Moody's cuts China 2022 growth forecast to 3.5% from 4.5%. And then, boom, Germany PPI. So this is not a misprint. This is a 37.2% annual increase in producer prices in Germany. So this is literally a more than 5% month over month increase. Now, obviously, this has a lot to do with energy, mostly involving energy, but it's still absolutely shocking to have 37% producer price inflation in Germany year over year. And, the Eurozone is seeing very sluggish growth still. So this definitely meets the criteria for stagflation. Okay, so we have stagflation in the Eurozone. We have stagflation in the UK. Not quite as acute in the US. Inflation is still under 10%, and there's still some growth, albeit pretty weak growth. Okay, but the US, North America, seems to be able to handle this a little better than Europe, mainly due to the fact that Europe made a lot of blunders with regard to their energy policy in the last decade, right? And I'm going to talk a little bit more about that in a bit. But this this PPI print is such a huge miss for the most important country in the Eurozone, at least, economically. Germany is the engine of the Eurozone. It's a big number, and look at S&Ps. Yeah, we're down. We're definitely down about 60, 70 basis points in the futures right now. But, look at where we've been. You got to put into context. The market is still handling this news pretty well. Okay. Okay, talk about nuclear and uranium in a second. But it's important to understand that these really high energy bills in Europe, where they're the highest, but also around the world. I mean, everybody's feeling it, just varying amounts. Everybody's feeling these cost pressures. This is a heavy tax on the consumer and business. And actually, it is deflationary longer term. I know that's hard for some people to wrap their brains around. But when you're sucking spending power out of the economy through this energy tax, it leaves less pent up spending power to buy other goods and services. So this is very negative for economic growth, negative for economic activity, and ultimately it's deflationary, as this chart shows, G5 credit impulse. Now, this is a different thing. It's showing some of the tightening of financial conditions that central banks have been doing in 2022. And it's also probably factoring in some of the weakening growth outlook that we're seeing globally, namely from China. China is a real wild card in this whole thing. And things have not looked good there for the last few months. I mean, we saw that, Moody's cut the growth outlook to 3.5%. I wonder if even that's optimistic at this point. It's just the zero COVID policy is a real problem in China. And there's a property bubble bursting at the same time there's a zero COVID policy, and the Taiwan situation is heating up, So how do the Chinese policymakers deal with all this? That's an unknown. That's a big unknown, and I don't profess to be an expert or even, reasonably intelligent on China. I'm just not. I read like everybody else, and I try to form some sort of understanding of it, but it is murky. And I can say that about a lot of things right now. It's murky. And when it's murky, it's okay to not have a position. It's okay to not have a strong opinion. It's not easy to figure this stuff out, especially now. But this chart is really interesting to me because it sort of jibes with the idea that this big energy tax and this tightening of financial conditions that we're seeing right now in the last few months is going to see inflation really drop hard, okay? But it's not going to be a good drop. It's going to be a drop that coincides with negative growth in a lot of economies, a lot of countries. So the fact that we're seeing this massive surge in PPI, this massive inflation in the Eurozone, and clear inflationary pressures in the US and throughout, the Americas, it's becoming so acute that some big things are going to change. They have to change. I am not going to just sit here and think that Europe's going to go into the winter laying down and just everybody's going to freeze and pay 2,000 euros a month for their heating bills. I just don't see that. There's going to be some desperate moves made here. We're already seeing Germany backpedal on the 3 nuclear power plants that they're supposed to be closing. They've extended those so they will continue operating. I believe that we're going to see a big shift to nuclear, okay? And it's interesting that Kazatomprom, the big, company in Kazakhstan, cut their uranium supply forecast significantly this morning. So we're seeing tighter supplies in the uranium market against the backdrop of articles like this and some major inflation in terms of all kinds of energy. Even coal is way more expensive than it was a couple years ago, right? We have the technology to solve this energy crisis. We have it. Mankind has it. It's available to us. The problem is the bureaucracy and the miseducation and misunderstanding around nuclear energy. But in 2022, We've seen Netflix documentaries about nuclear energy, throwing aside some of the illusions, some of the misconceptions that people had about the safety of it. Accidents in the past were all human error, simply put. And even like 3 Mile Island, which is in the US, Pennsylvania in the late 70s, okay, that was over 40 years ago. And that was pretty much all human error. And nobody died from it. Yeah, it was scary and it made global headlines for a couple weeks. But if that's one of the worst things that can happen, then you got to put it into context. This is a very safe, highly effective form of energy, and it can power the planet. It can fill the gap towards our clean energy future, right? And nuclear is clean, actually. So this article was interesting for me to see this week, and I'm seeing more and more like this out there calling for small modular, reactors, which is a technology, again, we've had for decades. There's just been a lot of regulatory burden and obstacles to advancing this. Well, what's possible? I mean, if we're facing a 1,000% or 1,500% rise in our energy bills across the economy, what's possible? Drastic times call for drastic measures and call for major rapid changes in the regulatory burden involved with things like nuclear power. Okay, so this is my thought, and just two names. This is not like a stock picking video. This is not a trading call video, but Cameco and NexGen are sort of the bread and butter in the sector. Cameco being the real like keystone stock. It's like when nuclear comes into favor and the uranium price is rising, the hedge funds buy Cameco CCJ on the NYSE. I think NexGen also kind of comes into that category at this point because it's on the NYSE now, and it's the number one asset out there. I mean, it will be the first to be acquired when we have a real bull market run. And the run we've had off the 2020 low is a bull market, but I'm talking about like that later stage bull market run where a big mining company or a big energy company comes in and buys up the best assets in the sector, like NexGen. Okay, so Cameco has also been dealing with a lot of FUD out there. We have this war in Ukraine with a nuclear power plant, one of the largest ones in the world, seemingly at risk due to, depending upon whose side of the story you read, either shelling or the Russians are putting explosives in it or whatever. I mean, it's just a lot of FUD. It's scary. But Cameco is holding up pretty well, and it's consolidating over many weeks and months, within a range. Some amateur technicians might say, well, that's a head and shoulders. Look, there's the shoulder, there's the head, there's the shoulder. Yeah, okay, maybe, but it would still need to break the neckline at least under $20 a share to confirm this is a completed pattern. We closed at 24.51 yesterday. So head and shoulder patterns, when they're not completed, can turn into continuation patterns and actually be bullish patterns. So I wouldn't put any weight in a little shoulder, head, shoulder until we get a lot more information. And actually, within the context of this trend, this is a very strong trend, uptrend, and the consolidation recently, odds, and this is just me throwing out ballpark figures based upon my experience, 65-35 odds say this goes higher, not lower. Okay. Uh, let's move on. So Cameco, this is the keystone stock in the uranium sector. It's still a 10 billion market cap. So this is not, when we compare it to like tech or something, this is tiny. This is tiny. You get a couple billion of inflows into the sector, and Cameco can go up 30, 40, 50% in a relatively short period of time. Yeah, it's a mining company essentially. It's a mining company with a utility sort of arm to it, but it's a mining company, and it has to deal with a lot of regulatory burden, especially being based in Canada, and that's sort of, I believe, why the valuation is punished a bit. Earnings next year projected to be about $1 a share, so at $24, it's 24 times earnings. It's not super cheap or anything, but those earnings are factoring in $50, $60 spot price. What if the uranium price goes back above $100 a pound? Then these earnings expand massively. Maybe they can earn $3 a share or $4 a share. And then what is the stock worth? Well, definitely worth more than it is today, right? And also, it's important to understand that the fundamentals may take a while to catch up to the market. The market will move way ahead of the actual earnings and fundamentals. And so it feels like we could be on the cusp of one of these runs in the uranium sector. Okay, it feels like that to me right now. So Cameco, NexGen, again, I'm not going deep into the weeds in the sector. You don't need to pitch me on your favorite stock in the sector. These two are solid. They're relatively safe in a risky sector. They're relatively safe. They're tried and true, and they will be the first two that the hedge funds run to if there is another bull market run in the uranium space. Okay. Just briefly wrapping up this video, I want to talk about some of the things that have been going on in the market, like this Bed Bath & Beyond, short squeeze, gamma squeeze, call it what you want. MindMed having a 250 million share trading day yesterday. So it's incredible that this market that was so full of pervasive fear and FUD and negativity just a month or two ago, now we're back to stocks trading more than their entire float in a couple of trading sessions and trading just enormous volumes with massive intraday swings. I mean, this feels like early 2021 again. Just looking at the last couple of days, last week in these two stocks. Okay, I don't think this is necessarily a good thing, and it has to be the Fed. Well, the Fed is not worried about BBBY trading. The Fed has to have some eye towards the amount of speculative froth in the stock market and not really loving what it's seeing here in the last week or so, because again, part of what the Fed wants to do is subdue valuations a little bit to help bring down inflation. And when you have this kind of money swashing around so rapidly and so enormously at such a high magnitude, this is not what the Fed is really trying to achieve, what it's trying to orchestrate to bring down inflation. But I will say that this huge energy tax that we're experiencing is doing a lot of the Fed's work for it, because as I said, it's sucking money away from huge segments of the economy, and it's going to have a very negative effect on growth and and price pressures down the road. And I think we're starting to see it, like Target. A lot of the retailers are reporting that they're having trouble, clearing inventory, and they're having to mark things down. I think we're going to see that become a trend. Retail, I don't understand why Bed Bath and Beyond rose 500% in the last month. That makes absolutely no sense. Actually, it makes negative sense because you think about housing in the US is coming under increasing pressure, people trying to sell. There's much less activity on the buy side. So people are not going to be wanting uh, home furnishings, pillows, pillowcases, whatever the hell Bed Bath and Beyond sells, soap, shower products, I don't know. But all that stuff, people are going to be buying a lot less of it, quite frankly, because that's the excess stuff you buy when you have extra money and you've made money on your house recently. The opposite's happening. Why is this company having this rise? Well, I believe it was manipulation, it was orchestrated, and it's going to come down very hard. I have a different opinion about MindMed. I actually like this stock. I like this company, but I also urge some caution in the near term, as you never want to pile onto a meme stock hype train like this until things settle down a little bit. The long term outlook, I believe, for MindMed is strong. It just needs to work through a little bit of this froth that's come in this week, which is, again, a little bit hard to understand. And I also think that the fact that you have a very big name investor who dumped all of his shares in Bed Bath and Beyond in the last 2 days into this pump, this is going to turn more people off to the stock market. They're just going to be like, no, I'm just going to put my money into a passive index fund. I can't beat these guys at their tricks. And the whole diamond hands and hodl psychology, I mean, you'd have to be very low IQ to still be trying to perpetuate that. I mean, it's hard to comprehend why anybody would be doing diamond hands or hodling with some of the action we've seen in the market in the last 18 months. Okay, there's always a time to sell at the right price, just like there's a time to buy at the right price and at the right time. One final comment. uh, Gold has pulled back to an important Fibonacci level uh, this morning, 38.2 retracement of the rally from 1680 to 1820. Let's watch this. Let's watch how gold closes the week here. If it closes above this level, especially if it rallies later during the day on Friday, I think that would be very constructive, because this would be a normal pullback in the context of a new uptrend. However, if it goes deeper, especially if it goes down back to, let's say, 1730s, that would not be a good look. That would not be bullish. The GDX, the gold miners are dealing with the same inflationary pressures that Germany is dealing with. A lot of big energy cost pressures, labor cost pressures throughout their business. The chart tells you all you need to know. It's a very strong downtrend. But if I'm right that they are in a bottoming process, a process that could last for another couple of months, this is something we want to keep an eye on. This is going to take time. And remember that every bottom starts with a higher low. Look at the candlestick that was printed yesterday in the GDX, a hammer, potential higher low there, but something that needs more confirmation and more evidence before we get too excited. So have a great Friday and a great weekend. Thanks for your time to watch this video.